My name is Jake, welcome to the channel. In today's video, I want to talk about some questions that I see all the time on my YouTube videos, whether it's on my own videos or other channels, that I watch here on YouTube, or just generally talking to people about dividend investing. I generally hear the same questions over and over again. And I thought it'd be interesting to kind of just sit back and, go through some of these questions and share with you some of my thoughts when it comes to the questions that I see more on a reoccurring basis. Now, I've been on YouTube for about 3.5 years now. I've seen a lot of different things and, I don't have all of the answers, but I think I can add a lot of perspective to some of the questions that many of you have and some of the questions that I see on a reoccurring basis. And I want to make sure that, I highlight that these are just my opinions. Like there's really no one size fits all to some of these questions. And we talk a lot about that on the channel that, investing is so unique to every individual because everyone is in a different situation. And the way that I'm kind of thinking about it, it's as if you and I were sitting, down for lunch and we were talking just casually about, different topics. And, if you were to ask me one of these questions, this is generally how I would respond to each one of these questions. But yeah, so today is the Monday the 17th. I'm recording the video quite a bit earlier today because I'm going to be traveling this weekend. So usually I film a video on Sunday afternoon. I work full time, and so today it's a little bit different. But yeah, so I'm going to do my very best to keep the answers as pretty much as clear and concise as I possibly can. And if I don't do that, it's probably going to look a little like this.
Because some people out there in our nation don't have maps, and I believe that our education, such as in South Africa and the Iraq, everywhere such as, and I believe that they should, our education over here in the U.S. should help the U.S. or should help South Africa and should help the Iraq and the Asian countries, so we will be able to build up our future for our children.
Thank you very much, South Carolina.
Oh my gosh. Oh man. All right, cool. So the first question that I see all of the time is this a good stock? Right? And then there'll be a ticker symbol of a company. And some of the times I'll know what the company is. Sometimes I won't. And so I see that more often than any other question is a lot of people will go in the comments section and they'll ask questions. Hey, Jake, or hey, Ian, or hey, whoever, is this a good stock to buy? And I think the way that I would respond to this question, is this a good stock, is if you don't understand how the business operates, if you don't understand how the business generates their revenue, as well as their competitive landscape, I would ask the question to you, why would you even bother investing into a company that you don't understand? Now, you could, I'm not the biggest fan of this question because it implies that you didn't necessarily do your research and you're just asking for somebody else's opinion. Now, it's possible that you've done the research and you're like, hey, Jake, curious what to hear your thoughts on this stock. I think it's a good company because X, Y, and Z. Then that's completely different. But if you're just asking, is a company a good stock or a dividend stock? I think you're asking the wrong question if you haven't done your initial research. If you ever find yourself asking the question, well, is this a good stock? You probably need to go back a step and think about, well, do I understand the business? Do I understand the industry? Do I understand, does this company have a competitive moat? And if you don't, then you already have your answer. You should probably be an index investor. You should probably not be investing into individual stocks. Or if you do, you should limit the amount that you invest into individual stocks because it sounds like you're probably not quite there where you should be, investing heavy into individual stocks. That's why I love the core and satellite approach to investing, which I shared a couple weeks ago, where you have your core, which is most likely low fee index funds like the broad US stock market or SCHD or VYM, for example. And then you have your satellite positions being maybe individual positions. But that's a question that I hear all of the time. And if you find yourself asking or wondering, hey, is this a good stock? Let me go ask somebody. You need to ask the question first, well, do I understand the basics? Does the company have a moat? What are their competitors? what is the sustainability of this company in good and bad economic times, and obviously all the other metrics that come with that. So that's how I would answer that question, or, that's something that I see all the time. Whenever I see that question in the comment section, and I'm sure I'm going to get some troll commenting, hey, is this a good stock? Oh man, you guys are, that's usually what goes through my mind when I see this question. All right, the next question that I see quite a bit is, why not just invest all into QYLD? Now, for those of you that don't know, QYLD is a covered call ETF. It follows the NASDAQ or tracks the NASDAQ. These covered call ETFs are not ideal for growth. They're not ideal for most investors who are following my channel. These are income-oriented investments. And the short answer of why not to do that is, if you want your portfolio to continue to grow, assuming that you don't reinvest the dividends, it can be very complicated. Your total return can slowly dwindle away with QYLD. Now, for the right person, it could make sense. Like, say, for example, you're retiring tomorrow and you have all the money in a tax-advantaged account like a Roth IRA. Well, then, yeah, you can invest a sizable amount into QYLD. But if you have 20 years, your total return is going to be nowhere near that of a broader index, for example, VTI or SCHD, for example. So in terms of why not to go all in on QYLD, it's, in my opinion, it really depends on the individual. But for many reasons, like tax reasons, total return reasons, that is why you would likely not want to go all into QYLD. But also just in general, just having everything, all your eggs in one basket into an ETF like this, in my opinion, is never a good idea, just in general. But that's just my opinion. Another question that I see quite a bit, for example, is why not just invest all into, company X, like Verizon or T-Mobile, or some company that has a really, really high dividend? Well, this is a good question. I mean, Warren Buffett invests a large percentage of his portfolio into Apple, Bank of America, into small companies. Why shouldn't you do that? Well, it's a good question. But the answer is, you're not Warren Buffett. Okay, you're not Warren Buffett, so stop comparing yourself to Warren Buffett. For most of us, we don't have millions and millions of dollars in resources at our fingertips to make decisions that would warrant the risk taking of over-indexing into one, or overweighting into one single investment. It's just too risky. There's no point. There's no reason to go take on that much risk. Now, there's great companies out there. You could invest a sizable amount into like Microsoft or Apple or something like that. And, you could spread it out that way. But just in general, I personally do not like overweighting into one individual company. Let me give you a random example. I love the company 3M. 3M is a great business. They have a lot of products. They're in a lot of industries. But with that comes a lot of risk because, you see the lawsuit that they're facing right now. Like, there's also a lot of uncertainty with that. And, 3 years ago, you would have never seen this coming. There's these black swan events happen all the time. And so for me, why I don't just invest all into one company is the fact that, why do you want to put yourself in that position? Why do you want to take on so much risk? And that's my opinion. Now, I'm sure there's going to be other people out there with a different opinion. If you overweight into one individual, you're saying that you know better than the market. And let's ask ourselves, like, honestly, do you really know better than the market what's going to happen in 20 years? Now, this question I get quite a bit. Why would I invest into dividend stocks instead of companies like Tesla? Now, Tesla is just a mere example. You could replace Tesla with any growth stock, right? So this question was asked a lot more last year during the bull market. Now we're in a down market, where the market is going down. So a lot of people are like, oh boy, just leaving growth stocks and going into value stocks. But the question really is, what are your goals? Now, you don't want to just invest into dividend stocks just because of the dividend. I mean, that's what every dividend, hater or contrarian will say is, well, this is specifically with the FIRE movement, right? The FIRE movement says, well, why would you invest only in index funds that only focus on dividend stocks, or only on dividend stocks? You're missing out on a large percentage of the market, which is absolutely true. And so the question of why you invest into a dividend stock is for example, based off of your goals, right? What are your goals? Let me give you an example, right? I love taking this example of real estate. I think real estate, most people can tangibly understand it. So everybody knows what house flippers are, right? You buy a house that's at a distressed price. It needs some fixing up, a fixer-upper. You buy the house, you put some money into it, you fix it up, and then you sell it, and then you flip it, right? You're flipping it. Now, I view investing into growth stocks like flipping real estate. You buy something low in anticipation that it's going to go up in value, and then you're going to flip it. You're going to sell it. On the contrary, with dividend stocks, it's like having a rental property. You buy a house, you rent out the house to a tenant. The tenant pays you money to live there and pay you in the form of rent, and you get that monthly income. And so for me, dividend stocks are like rental properties. I'm not looking to flip them. I'm looking to live off of the cash flow that asset is paying me. And so that is why I invest in dividend stocks instead of just only looking to invest in the next flip property. Okay. Now, I hope that a lot of you can understand that. For me, I like to make it tangible, and that's how I view growth investing versus dividend investing. Same with flipping real estate versus renting out real estate for cash flow. Okay, hopefully that makes sense. The next question here is, in which account should I hold my dividend stocks? This is a really good question. Well, first off, it depends on what your goal is in your time horizon. If you're 20 years old and you want to live off of your portfolio in 10 years, well, you probably should go with a taxable account because you're not going to get any fees to access the portfolio before the age of 59 and a half. Now, if you're in your late 50s and you're funding your portfolio, it is an absolute no-brainer, in my opinion, to go with tax-advantaged accounts. 401ks, HSAs, Roth IRAs, SEP IRAs, all of the above, right? But the important thing is you have to understand holistically how each account is going to serve its purpose. For example, with my wife and I, we invest in our Roth IRA, and we invest primarily in growth. We're more growth oriented because we have a 25-year time horizon. And within the next 25 years, hopefully, that portfolio will have grown. And then what we plan to do is sell out of the growth ETFs. I don't own any individual stocks in my Roth IRA, only index funds. I'm looking to sell the index funds and then reposition them, AKA flip them into other assets that will pay me cash flow. Okay, whether it be dividend stocks, a rental property, whatever it may be. And that's my plan, how I do it. But that's really, to answer that question, in which account should you hold your stocks? You have to have a holistic approach of how you view each account type, what the priorities are there. But generally, you want to hold REITs in a tax sheltered account if possible, right? You want to hold, if you do decide to have bonds, obviously in a tax sheltered account. It all has to do with taxes and your time frame in which you plan on using or taking out the money. So those are the things. And the answer here, now really quick, when I was in my late 20s and I was thinking, well, I want to reach FIRE well before I'm 59, but everybody's telling me to invest into my 401k and my IRA, and I'm just scratching my head, but I want to retire, in my mid 30s, late 30s. Well, how does that work? It's very possible that you are different than the majority of people. And so you have to think differently than the majority of people. And the right scenario for you may be different than the majority of people. Okay. And I struggled with that, or not necessarily struggled, but I kind of went in circles thinking, am I doing the right thing? I'm doing something different than everybody else. Is this really the right thing to do? And after educating myself and understanding, as my financial literacy increased, the light bulb came on. It was like, oh, I am different. I don't have massive amounts of debt. I don't have a car payment. I'm different, hopefully in a good way. My wife kind of thinks in some ways not so good. I have many different flaws in different ways. We'll leave that for another video. I'm normal, but not normal. Okay. And so many of you watching my channel, you're probably very similar, right? You're probably like, you don't fit the average description of someone that would maybe, fit the description of what people perceive as the norm. Okay. But you have to decide what that is, right? So, but that's how I would answer that question. The next one is a really good question, and I get it a lot. And there's really not a straightforward answer for everyone because everyone's in a different mindset when you view international stocks. So my view on international stocks is I personally, I have in my Roth IRA, I have VXUS. It's an international ETF, but only a small percentage. I think less like 10% or something. And so I personally, the companies that I invest in, they're large national companies. They're international companies. I invest into McDonald's, for example. I invest into Procter & Gamble, and you can get those products all across the globe. But for me personally, as a U.S. citizen, paying taxes in the U.S., there's a lot of advantages of investing into U.S. companies because you don't get the international tax. I'll give you one quick example, and I've shared this a few times on the channel. I really like Hershey's, the brand Hershey's. It's a great company. I think they just increased their dividend by 15%, by the way. Really great company. I also really like Nestle. And if I were to pick, I would actually rather invest in Nestle than Hershey's. But Nestle is based out of Switzerland, I believe. It's out of Switzerland. With Switzerland, I think there's a 30 or 35% international tax. So if I got $100 in dividends, they'd take away $35. And so for me, why would I invest in a Nestle when I could invest into Hershey's and not pay the 35% tax? That's one reason why I, as a U.S. citizen who's paying taxes in the U.S., prefer investing into U.S.-based companies, mostly because of the taxes. Now, there's other reasons with the accounting practices of other international companies that I won't really go into, and the risk and the currency risks, all of those things. But for me, mostly, it's the tax reasons in most cases. So, but that's how I view international stocks. But however, there's a ton of great international companies. For example, in Canada, there's some amazing financial institutions in Canada that are much more stable than US banks, for example. So you got to, invest in what you know, and yeah, but that's just my opinion. All right, the next question here is why not to invest into bonds? Well, bonds are very different than equities. It's different, and for me personally, it really depends on your time horizon. And it also depends on your risk tolerance. And so for me, the only reasons why you would necessarily invest into bonds are a couple reasons. One, you don't like the volatility in the market. So obviously bonds are going to smooth out that ride, to quote J.L. Collins. Bonds will smooth out the ride in your portfolio. Also, you want, so you don't have the fluctuation. You don't have the emotional roller coaster with investing into bonds in most cases. And the other reason is you want to be pretty liquid, and you anticipate selling part of your portfolio in the near future. So obviously then you would want to have, or consider to have bonds. Okay. So for me personally, with my time horizon, it makes absolutely zero sense owning bonds. It would just be very difficult based off of historical returns, which are never guarantee of future returns, to reach my long-term goals with bonds. All right. The last question here that I want to answer is actually not something that I see a lot, but it was a question that I had when I first started investing. So many of you know I used to watch, or I still do, watch PPC Ian. So Ian was one of the first YouTubers here that I would watch when it came to dividend investing. And Ian would talk a lot about yield on cost. And some of his older videos from 4 or 5 years ago, he'd talk about yield on cost. And I just, for me, it was difficult. I didn't really grasp what yield on cost was. And so what is yield on cost? And in order to answer this, I'm actually going to share my screen here, and I'm going to walk you through what yield on cost is and how you can find it, how you can see it. So I'm going to use a company, for example, Pepsi. So yield on cost is, let's say, for example, I purchase PepsiCo at $172. And PepsiCo is currently paying a dividend of $4.60. So my yield on cost would be the current payout based off of the share price that I purchased it at, and that would be the yield, right? That's the yield that I would get based off of the cost of $172. Now let's assume, for example, next year Pepsi increases or raises their dividend. Let's say they raise it by 10%. Well, my yield on cost from the purchase of today, this yield just increased 10%. I didn't have to work for that. I didn't have to work my butt off at corporate America, to get that raise. I got it from all the employees at PepsiCo doing their job, and I was rewarded as a shareholder in the form of an increase in my dividend, thereby increasing my yield on cost. Now, how you can do that is you can actually factor that in here in Seeking Alpha. So what I like to do oftentimes is I will go in and I will look at a company and I'll look at their yield on cost, because I want to see reasonably how quickly have they grown their dividend over the last 5 and 10 years. I do this, like, guys, I use Seeking Alpha every single day. They actually sponsor the channel, but I do this literally every single day as I go and I research stocks, just because I'm a nerd like that. But every company that I own, or if somebody talks about a company in a video that I watch, I always come to this and I always look at the yield on cost. And so what I want to see is, okay, well, 5 years ago, if I would have bought PepsiCo 5 years ago, what would have been my yield on cost 5 years ago based off of the share price and the dividends per share 5 years ago? I would have a yield on cost of 4%, 4.05%. But we just found out, right, that PepsiCo has a dividend of 2.7, right? But if I would have been buying the last 5 years, my initial tranche or my initial purchase would be a 4% dividend yield. Now, this is where it gets really exciting. After 10 years, my yield on cost, if I had held this company, if I invested in Pepsi 10 years ago, I'd have a current dividend yield off of my initial investment of 6.5%. I love this. And so what I personally do all the time is I go and I look and see, okay, if the company doesn't have a 6% over the last 10 years, it's probably a slow grower. Let me use another example. So I love to compare different companies like this. So what I'll do is I'll go to look at McDonald's, for example. McDonald's is fairly similar to PepsiCo, but I like looking at the 10-year. Look at that. It's over 6. I didn't actually prep this in advance. I'm just doing this off on a whim here. So over 6.5% for PepsiCo. What is Waste Management? One of my favorite dividend stocks. Let's take a look at Waste Management. Waste Management over the last 5 years, the yield on cost would be over 3%. What is it over the last 10 years? Over the last 10 years, it's 8%. If I would have bought Waste Management 10 years ago, I'd have an 8% yield on cost. Now, let me use another example of maybe a slower grower. Let's look at Kimberly-Clark. Kimberly-Clark's a little bit slower. So the yield on cost is 4% for 5 years. Let's look at it for 10 years. 10 years, it's just under 6%. Interesting. What's another one here that I could use that's a pretty popular company? We got Hershey's here. I was looking at Hershey's earlier. Let's take a look at Hershey's. Hershey's 5 years, 4%. Let's look at the 10-year. 6%. So you can see there's a trend here, and I actually didn't plan this, but for me, my gut check when I'm reviewing individual stocks is, do they have at least a 6% yield on cost over the last 10 years? If they don't, that concerns me. Okay. And so that's kind of my threshold is, if they're at 6% yield on cost over the last 10 years, then I will dive a little bit deeper. But yeah, that's yield on cost, and understanding yield on cost was so impactful for me when I was a new investor, because I would hear that term all the time. Yield on cost, what does that even mean? And once I understood it, and then you understand the snowball effect, the snowball of dividend investing, that is the snowball of dividend investing, is the yield on cost. And if you're reinvesting the dividend, that's how you get that snowball moving. Okay, so I thought that that was interesting. Those are some of the questions that I hear on a reoccurring basis. If there was a question that I didn't answer that you hear or see quite a bit, let me know in the comments and I'll include it in a future video here. But I thought that those were some of the ones that I see pretty often. So I hope that this was helpful. I hope that you learned something new. But yeah, thanks for watching. I'll catch you everybody in next week's video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.